Hey traders, welcome to Charts and Coffee. Happy Friday, everybody. We're taking a look at the last trading day of the week, and what a week it has been. And as we're wrapping up the week, there's probably a few things to take a look at in terms of the current market structure. The daily time frame of the NASDAQ remains in a downtrend. And yes, that rally that we saw on the 9th was not enough to take the downtrend on the daily out of its context, which continues to be lower. Same thing goes with the S&P, the Dow, and the Russell. These are not downtrends that were necessarily new. In the case of the Russell, I do want to mention that if you look at the trend that preceded a little bit of neutral action and then the resumption of the downtrend, let's remember that the most likely continuation is in favor of the trend that was. So if there are periods of time where the equity markets move higher and then move sideways, the presumption should be, until there's a setup otherwise, that continuation, not reversal, but continuation is the likely direction. And you can see that really clearly here on the Russell. Quite weak throughout most of March, a little bit of a reprieve, and then a resumption of the downtrend. Now, of course, we know there's news and all sorts of reasons and whatnot for everything. But, I was thinking about something when it comes to news, and I tweeted it out or posted it yesterday on X. And this idea that the best way to view news, and I know we're getting tons of it and constantly, but the best way to view news is to just make some very simple assumptions. One, that for me, I've always presumed I'm the last to know. Not the second to last, not in the middle. I'm just going to always presume I'm the last to know. I'm also going to presume that if we're talking about a topic, you and I, it doesn't matter what it is. It might be an upcoming sector. It might be a stock. If there's a narrative, some sort of trade story around it, I'm going to presume someone else has already thought of it, and it's by and large discounted. Now, the logical thing is, well, what if we're there early? Well, let's go back to sort of rule number one. We're never going to be there early. Let's just presume that. Yes, if 100 times we think about a news story, maybe once, maybe twice, we'll be there early. But if you think about the probabilities, not exceptions, right? Traders tend to lose because they think of themselves, their ideas as the exception. So I never want to do that. If we're talking about news, let's presume someone else is either got there first or already knows. So case in point, what's really interesting about the 9th is that most of the point of control on that straight up day was down near the lows of the wick. I'm not going to make any assumptions about what that is, but ultimately what's really interesting about moves like this is that if traders think, oh, I'm the first one to have seen that post, probably not true. And so the best way to empower ourselves to fend off that temptation to trade news is just presume that we're always the last to know. I've always done that. It has served me really well, and I think it's a particularly appropriate topic for what we're dealing with right now. Another thing too to keep in mind is if you're asking, okay, Rog, but is there reason to watch news or even data, which I would categorize under news? The only way news is helpful is if we're betting on it being wrong. And this is tricky. Now, wrong can mean that whatever that bullishness wasn't bullish enough, or wrong can mean it was too bullish. Same thing goes in reverse for bearish. And it's then a little bit of a contrarian move. I don't want to make contrarian trades, but if I'm looking at, for example, the NASDAQ, let's go back to the NAS from that rally on the 9th, and even on the little bit of strength we saw on the 10th before the sell-off, if that news carries price to a level that then becomes useful, that there was always a setup waiting, say just shy of 19.5. We don't know why, what news, how long it might take to get up there, but if the structure is still a downtrend and the catalyst, in this case, the post, carried things up to almost 19.5, the question then becomes, is that a setup? Is there a trade to be had there? And, like you, I do have a sneaking suspicion. Obviously, we're going to continue to see a lot of news. We're going to continue to see a lot of unscheduled sound bites and, so and so said this and it's going to stream by somewhere. Remember that sometimes these are just rumors, they're not even true. So you want to be aware of that as well. So if we step back and look at two things: one, the setup. Has price carried price to a level? Has price action carried by the news gone to a certain level that's useful? And two, and this is more of a volatility conversation, however it is you're measuring volatility, right? Maybe you're using the VIX, maybe you're using some sort of market internal, maybe you're using um, pull call ratios, average true range, whatever it is. I happen to use something called price movement ranges. So if I see my PMRs are inverted, meaning the volatility has exceeded the 68% probability of what's normal. The only way to have any kind of useful assessment of volatility is to be able to have contrast between what is now and what's normal, right? So there's no such thing as a particular reading on the VIX that's somehow full tilt. It's always in relation to the range it's been in and whether it's quote unquote normal. It's been abnormal volatility for quite some time. I mean, it's been abnormal volatility, frankly, since the third and fourth of this month, and it continues to be that way. Maybe the current candle here on Friday starts to normalize that volatility, because if volatility is way beyond normal, do you or I think a 3 or 4 point stop in the S&P is going to account for price action that's in that full tilt? I'll use the 32% less viable, or I should say less continuation probabilities. They're not as likely to one happen, and they're not as likely to persist for a longer period of time. So we just kind of revert back to, are things normal? And until they are, it's going to be very difficult to manage risk. It's not that there aren't any interesting opportunities. Of course there are, but can we manage risk? That's always the barometer. Okay. All right. So as always, hopefully that gives you a pretty good idea of what it is I'm looking at. I just realized I don't have my clock on the screen. So let's see if I can't remedy that. And let's see, where is that clock? There it is. And so if I'm thinking about what it is I need to do next, what is it that I want to see before I start, getting active this month? I haven't been that active this month. We've had some day trades. That's been fine. We've had a number of longer term positions. So then that kind of brings us back to, what are the three things that I like to do? Think of them as, what are the businesses within the business? So we've got this trading business, and then we've got our, so say, different products, if you will. So think of yourself as a business owner. What are the things, what are the widgets that you sell? Well, in my case, I think about, what are those individual strategies that I'm using under this overall business of trading: day trading, swing trading, position trading. My day trading on the 5-minute, my short-term and long-term swing trades, and my longer-term position trades. And sometimes one or the other just isn't all that viable. Sometimes one is really great. Right now, my position trading opportunities are plentiful, and day trading opportunities are pretty darn good too. It's in that middle group, the swings, that's not so great, or active, I should say, at this moment. So think about all the different things you're doing under the umbrella of your trading business. I doubt anyone listening to me right now is just a day trader, or just a position trader, or just a swing trader. You probably have at least two, maybe more. I don't like more than three. I'm a pretty simple carbohydrate. I don't want more than three. I want to be able to take my attention through every single trading session and dedicate about an hour to each thing that I like to do. Day trading for about an hour, swing trading, opportunity scanning for about an hour. And then, 30 minutes is usually pretty good for the weekly, because we're not going to have as many candles to look at. It's one candle a week. So what I saw on Tuesday is probably not all that different than what I'm seeing on a Thursday or Friday. So they're slower and probably don't take as much time to scan and prepare for. We've been long Coke. So the most recent swing trade we have on is a long position in Coke, long calls. Four most recent position trades we have are Coke, Altria. These are all long calls, by the way. Coke, or long shares. Coke, Altria, Walmart, Communications, and we had a day trade in gold yesterday. I'm flat on that. I'll start with a fresh eyes, blank page, and look for opportunities next. All right. So that's where I am. Now, let me know what uh, charts you're looking at. I wanted to show you a couple of the things. I haven't seen any questions come through, but yeah, let me know what's on your mind. Let me just show you a couple things here. That's kind of interesting. This is something called trueflation, right? We want to measure what's going on with inflation. We had a CPI this week. What was interesting about the CPI, it was really overweighted with the drop in things like fuel. So granted, is there ever going to be a real view of inflation? Even with the views of inflation that we get data wise, PCE and CPI, they're both calculated in two very different ways. They're weighted with lots of different items, if you will, like separating food from energy and housing and everything else. So, inflation can be discussed in a very segmented way, or it can be discussed in a broad way. The market participants, the Federal Reserve, that those headline numbers tend to be that broad look. This is no exception. Okay, so, I don't know that anyone's disagreeing that inflation's dropping, but where is it dropping is going to be the big question. If you take a look at the CPI, like I said, it made me raise my eyebrows. It's not as low as it may seem because, again, fuel had a disproportionate weighting and it's had a disproportionate move to the downside. All right, this is another one to look at because there's been, whenever I open X, everyone's talking about yield. So let's put this to rest with data. What cracks me up is there's a lot of times people who consider themselves macro traders using macroeconomic factors will talk about what's happening, but at some point, almost inevitably, the conversation devolves into what they think and feel. Right? Trading isn't a touchy-feely thing. We're not looking for hopes and wishes. Trading is not blowing out the birthday candles on a cake. Yet a lot of times macro sort of devolves to that almost inevitably. What's the data? A real macro. Most of my mentors who were, I would consider macro-based traders, did two things. One, they had huge time horizons, weeks, because as we know, macro can be, moving around at the glacial pace of the tectonic plates. Yes, when the plates move, it's volcanoes and earthquakes, but for the most point, there's not much happening in between. It's a very slow, very long-term outlook. So then if we add trading triggers to that data, we have a much clearer idea of when that macro might actually have some influence. Let's talk about this 10 and 2 year, because my gosh, have more people been talking about this and just truly without a clue in the world. We are traders. We are not macroeconomic analysts. I'm not teaching a college class. My job is to manage risk and put on trades with another group of traders in the Sector Secrets Mastery who want to manage risk and put on trades. So let's talk about this. This zero line here is the inversion. And you can see here it's the 10 and the 2. Okay, you can have all sorts of inversions, but this is probably the one that's most commonly looked at, 10 and 2. So right here, you've got your inversion, if you will. All right, so what do people say when things invert? Oh my gosh. And probably the most common inversion is the reinversion. So you have this first move right here, which inverts briefly, and then you have your second. Oh yeah, the world's going to be absolutely toast, right? Well, in fairness, when we had a fresh inversion way back here, what did 2022 look like? Well, some of you might remember it took about 9 months throughout 2022 to pull back just over 20%. It didn't happen in a handful of days, so it didn't feel the same, but it was in essence from a price movement, from a percentage movement, right? So there you go. There's the inversion, but that was in 2022, and yeah, there was a lot of chop in 2022. But that underneath all that, right? Underneath all that is what? Well, if I go out to a weekly chart, remember I said all of our trading should be like a business. We have this business of trading. Right? Whoever's out there, Raghee's Trading Emporium. And you walk into Raghee's Trading Emporium and you're going to see a section for day trades, and you're going to see a section for swing trades, and you're going to see a section for position trades, right? So if I'm a position trader, 2022 was a pretty darn good time to find those pullbacks on stocks, on indices, that I like that jumping off part. 10% gets my attention, 20% starts to get my capital. At 20%, I'm looking at a setup. What are the setups to the long side, knowing that usually 20% pullbacks historically offer opportunity? So again, we got to go to the right section of the trading store, if you will. So yes, 22 was rough, and you can see inversion, re-inversion. I was always taught it's the re-inversion that's truly the trigger. Well, we had that. Cool, and 2022 was tough. But look how long it was inverted. This is where your kind of hobbyist macro folks are going to get themselves into trouble. Come 2023, we started to bottom out on this. And let's think about what happened through 2023 and most definitely 2024. What did the stock market do? Right? We were still inverted up until about, you can see here, almost 3/4 of the way through 2024. I'll tell you right now, while this supposed end of the world inversion was still not fresh. Remember, the fresh inversions are helpful. Prolonged inversion, like anything else. I know in Florida, right? When it starts raining, especially during the rainy season, it's going to rain for weeks. We know it. We get used to it. We're not happy about it, but we get on with things. Guess what? Even in the case of inversions, people just get on with things. So imagine if you're still looking at, oh my gosh, we're inverted, not a fresh inversion, which is what this was, but we remain in this area. We just kind of get used to it. And if you think about, well, let's not buy in 2024, let's not buy in 2023, that would have been kind of dumb, right? We that would have had traders miss out on, especially Q1 of 2024. It was an epic time to be trading. And most of 2024 was pretty darn tradable. So this is what I'm trying to say. Be careful of this one-sided illusion that macro applies to shorter term duration trades. It doesn't. And by the way, this is also how ludicrous this is. We uninverted, right? So here's that zero. And by the way, this data is FRED data. This is from the St. Louis Federal Reserve. It's called FRED, F-R-E-D. Any one of you can go get this chart. It's online. It's free. It's provided by the FRED, St. Louis Federal Reserve. We uninverted. Okay, now what? So folks who have been doom and glooming for, I don't know, years at this point say, see, this is what I was talking about. Please, right? This is what I want to keep you all away from, because it's going to be terrible advice that looks brilliant. And there are perma bears out there. There are people who love downtrends. They love when the markets start to crash. And that's okay. There are people who love when the markets rally. But most of those types of traders are, over a longer period of time, going to be unprofitable, because it's not only an opportunity cost to be a perma bear and to just have this, the markets are going to crash type conversation. It's an opportunity cost, but it's also, well, just a dumb trade, because it's cost a lot of opportunity to the upside. As you can see here, this is 2024, this is 2025, this is April of 2024. All right. It's cost a lot of opportunity, because look, I'm not buying, and I don't think anyone here is buying up in here, right? I hope not. And yes, this is a lot of movement lower, but let's also step back and say, and ask yourself, obviously I don't know what everyone's duration of trading is, but if your trading duration is 10 days, do you give a rip about this stuff? Or are you going to say, Rog, it's just time for me to be bearish for a brief period of time? Exactly. So please, please, please don't let this sort of armchair macro, analyst type, and I see it on TV all the time, don't let that influence what you're doing. Know which corner of the store you're going into. Day trading, you know what day trading really should be called? I don't care what happens tomorrow. My focus is today. Swing trading, I care what's going to happen over the next 2 to 10 days, right? Position trading, this is when we say that Wall Street's the one place they throw a sale and nobody comes. And this is why I've been talking so adamantly for weeks now. Please put that longer term position trading watch list on a sticky note on your desk and wait for those longer term setups, because 12 to 18 months from now, I have a sneaking suspicion. I'm not saying we're going to be in a screaming uptrend, but I have a sneaking suspicion we're going to say, hey, oh, that was the sale. That was Prime Day. That was Black Friday, right? So one person's, Black Monday is another person's Black Friday, if you will, in terms of time horizon and time frame. So that being said, That being said, um, ultimately, when I turn on television, that's a lot of what I'm getting. It's just so wrong. And I don't want anyone here to be basically victims of clickbait and missing out on this. I think a lot of you who have been looking at the weekly saying, Rog, I'm not even in your room and I'm seeing what you're talking about. That makes me really happy. This kind of knowledge, how to put on position trades, how to grow capital over the course of years and decades, that's one part of being a trader. And I really think that should just be knowledge that everyone knows to take advantage of. And when you do, while this may not be fun, it's probably temporary. And you don't lose unless you sell. Let's go shopping, gang. And I'll continue to give everyone data so you can make your own informed decision. No fear mongering, right? All right, gang. Have a great rest of your day. I will talk with you all on Sunday for our top tier outlook and Sunday Q&A. Be good to each other.